Hey all, welcome back to my channel. My name is Prateek Vyas and today we plan to talk about an introduction to financial accounting. Now, an introduction, why, you may ask? Well, financial accounting is such a broad topic that I don't think I could do justice by making an hour or an hour 30-minute video. So I decided that I plan to make a series of videos. I want you, the viewer, to enjoy what I say rather than just simply swallow all the information down. So it will be a lot more digestible in that sense. Now, it's not going to be like 40 videos. It's probably going to be between 5 to 10 videos where I talk about assets or liabilities. So I'll break it down and make it into chunks rather than whole bites. So yeah, let's get into it. So what really is accounting though? Well, as Professor Brian Boucher of Warren puts it, it's the process of recording financial transactions to provide summary statements that evaluate the company's overall financial status to different users. Now, you might be wondering why I have three numbers in the midst of this definition. Well, that's meant to highlight three main components that make up accounting. The first one is recording financial transactions. For recording financial transactions is a critical part of the business. After all, it does provide the data that ends up going into the summary statements. Summary statements include SEC filings, such as the 10K and the 10Q, which also include the income statement, the balance sheet, the statement of cash flows, and the statement of shareholders' equity. Basically, summary statements are numbers and compilings of data that allow someone like stockholders, investors, or even the general public evaluate the financial status of the company. The different users part is meant to show the diversity beyond the public, as after all, it's not only the manager or CEO that's looking at these statements. But even though accounting has one definition, it takes its form in many different ways. The three most prevalent types of accounting that are seen today are financial accounting, managerial accounting, and tax accounting. The one that we'll be looking at is financial accounting. Even though we plan to look at only one out of the three different types of accounting, that doesn't mean it's going to be all smooth sailing. However, I will try to make it as easy and understandable as possible. So let's dive in. Let's look at the three different reports that a company must file when financial reporting. They are the 10K, the 10Q, and the 8K. The 10K is the annual report. It happens once every year at the end of the fiscal year, and it's heavy and loaded with information. Although the 10Q and the 10K might have the same income statement, the balance sheet, the statement of cash flows, and the statement of shareholders' equity, the 10K goes very much in detail, having extensive footnotes and talking about stuff that they hadn't disclosed in the 10Q. The 10Q are the quarterly reports, and they're more common to see. Just like I said earlier, the 10K and the 10Q might have the same statements, summary statements. However, it goes less into detail. The 8K is kind of an outlier, but it's still as important. Say if an event were to occur prior to the end of the quarter that needs to be reported, such as resignations, big customer losses, lawsuits, then you must file the 8K. But how do you really file them? What are the standards? Well, the first standard that we have is GAAP. GAAP is the generally accepted accounting principles. It's used by the US and it's delegated to the Financial Accounting Standards Board, also known as FASB. The international standards for accounting are the International Financial Reporting Standards. They control all the accounting standards for all international countries, and they are an alternative to GAAP, which kind of shares some similarities. But even though we know the standards and the different reports possible, how does financial reporting actually work? Well, it starts off with the managers. Managers control the financial statements since they use the corporate money and know what's happened to it. However, we know that exposing the financial statements at such a low level without any filtration can lead to manipulation, fraud, or even wrongful information that misleads the investors and the stock analysts. Thus, we have the audit committee of the board of directors. They provide oversight over the process, with auditors hired by the board to look over the managerial financial statements. However, we know that even bribery or even shady kind of things can be going on behind the scenes that allow the audit committee and the managers to get away with certain crimes, I would say. Thus, we have the SEC. The SEC intervenes in the managerial financial statements if a violation is found, and they begin their investigation. However, do we think that 3 layers is enough? Maybe not. There can be small stuff that pass by even the SEC that no one knows about. Then we have the stock analysts or the media that actually provide the biggest checks on accounting. Now that you have a basic understanding of what the fundamentals are for financial reporting, so the hierarchy, the different reports, the standards, what accounting really is, let's give you a glimpse into what we plan to talk about over the next few videos. So what are the different types of financial statements? Well, let's look at them. The first one is the balance sheet. The balance sheet reflects the overall financial status of the company with 3 main aspects: assets, liabilities, and shareholders' equity, also known as stockholders' equity. Assets, in a general sense, simply means something that is valuable or will hold value for someone or something. Basically, with a small tweak, we can come up with a business definition, which are resources owned through past transactions that are expected to have future benefits for the company, either economically or financially. Liabilities, on a general sense, are simply claims on those assets by creditors that represent an obligation of a future payment, an obligation that is rooted from goods or services that have not been paid off yet or are in the process of being paid off. Stockholders' equity, or shareholders' equity, as I said, are basically claims on assets by the owners of the company. This includes shareholders, which is contributed capital, or even through operations, which is retained earnings. Through these 3 different types of key components of the balance sheet, we can create the equation assets equals liabilities plus shareholders' equity, where both sides must balance. This equation is key to understanding the overall debit and credit bookkeeping concept. So the second statement that we'll be looking at is the income statement. The income statement is a summary of the result of operations using accrual accounting, or accounting that's based off of revenue and expenses. This revenue and expense recognition is tied to business activities rather than cash flow. So the number does not mean how the cash moves around in a company or the change in cash, but it actually means when the goods and services are provided. By number, I mean the net profit or whatever you get at the end of the income statement. Now, this is key to understand as it allows you to understand the differences between the income statement and the statement of cash flows. They have completely different motives and thus must be analyzed in different ways. The equation that is centered around the income statement is the net income is equal to revenues minus expenses. It's simple, however, it's also important to understand that recognizing revenue and expenses may get challenging at times. This is all you need to know for now. However, just keep this in mind since we'll be implementing this and looking at this further later on. The third statement that we plan to look at is the statement of cash flows, which reports changes in cash due to different types of activities. Now, although there are only 2 bullet points that I've stated, we'll go seriously in depth as we'll look through operating, financing, and investing activities, the 3 different components that make up the overall statement of cash flow. Now, the net change in the cash balance is made up of net cash from operating activities plus net cash from financing activities plus net cash from investing activities. However, as I said, there are smaller parts of operations, financing, and investing that affect the overall cash flow. This is all you need to know for now, and of course, we will be looking into this further later. The last statement that we'll be looking at is the statement of shareholders' equity. Basically, like it says, it represents the changes in equity. It identifies the part of the overall balance sheet that talks about the claims on assets by owners of the company. It's made up of share issuance, which is including contributed capital, which includes stock, treasury stock, which is basically repurchased and reissued stock, and retained earnings, which is simply money that arises through operations and save money over the years. We'll be looking into smaller, kind of more finite details. However, we're not going to be looking at that right now since this is simply an introduction. And that's the end of the video, folks. Hopefully throughout this video, I was able to give you a good or fundamental understanding of what accounting is, what the different reports are, what different standards there are, and just simply give you a glimpse into what we plan to talk about. If throughout these next few videos you feel like there is something that I could have expanded on more, or if you're confused about something, leave it down in the comments below. I'll respond to it, or I'll try to put it in my next video and kind of expand on it. Anyways, thank you guys for watching. See ya.